There has never been a greater time than now to invest in the Metro Detroit area, and there is no other investment firm better qualified than Platinum Real Estate Holdings. With 40 years experience and over 1,000 homes sold, let Platinum Real Estate Holdings assist you with the purchase of a city-certified home of the highest quality. Turnkey properties, screen renters, yielding instant cash flow. Well, what are you waiting for? Call or visit us online today. Welcome to the weekly recap for the week of April 11th. Today's recap will cover the advantages and pitfalls of a home equity line of credit, what the best market is for a single-family home investment property, and lastly, the 8 non-negotiable habits of a successful note investor. This week's recap begins now. So, you want to get a new roof or windows for your home? Your secret weapon could be a home equity line of credit, or HELOC. A home equity line of credit is different than a home equity loan. A home equity loan allows you to borrow a lump sum at one time with set payments at a fixed interest rate. Instead, with a home equity line of credit, you get an approved credit line up to a certain dollar amount, and you can borrow over time at a variable interest rate, paying interest only for up to 10 years. But wait a minute. Some people have said all home equity loans are bad. Not true, says Jamie Hopkins, co-director of the Retirement Income Program at the American College of Financial Services. It's not the loan, it's how the loan is potentially used that's dangerous. Hopkins' advice is to have financial restraint. He says, have a plan to pay it back in the short term. Before you get a HELOC, ask yourself these 5 questions. Do you know what you're going to spend it on? Are you going to be tempted to use it to buy luxury jewelry, go on an expensive vacation, or eat out more? Number 2, do you really understand all the terms? HELOCs typically have a 10-year drawdown period with a 20-year repayment period. HELOCs are advertised with no closing cost, but watch out for appraised fees and ongoing annual fees. Number 3, how are you going to pay it back? If you take out a HELOC and pay it back after 3 or 5 years, that's one thing. But if you've got it for 20 or 30 years, then you really have to think how it impacts your cash flow over time. Number 4, how does it fit in with your overall financial plan? Tapping too much of your home equity for unnecessary items can leave you with no buffer zone to use later in bad situations, Hopkins says. Say you lose your job, or you need to pay for a critical illness or long-term caregiving cost. And lastly, number 5, have you considered alternatives? If you're 62 or older, a reverse mortgage line of credit might make more sense than a home equity line of credit. It's permanent, so you don't have the risk of cancellation. A reverse mortgage line of credit is more expensive than a home equity line of credit, but the fees have come down dramatically in the last 10 years. Moving on to the second topic, what is the best market for a single-family home investment property right now? It's clear that the housing market is heated up, with a lack of inventory for sale pushing up prices and making conditions tough for would-be homebuyers. However, it's a great time to be a landlord. And believe it or not, the number 1 county among the 448 counties analyzed is Genesee County. In case you don't know, Genesee County encompasses Flint, Michigan, and tops the list of single-family home growth markets identified by RealtyTrack, an Irvine, California-based housing data firm. I know you're asking yourself, how could a place with a lead-tainted water supply possibly be a good rental market? Well, it's really a case of pure math. In Genesee County, home sale prices are low, while rents remain relatively high. Here's how the math works. If an investor pays the median home price of a 3-bedroom home in Genesee County of $80,000 and rents it out for the median annual rent price of $12,216 per year, the investor makes an annual gross rental yield of 15.3%. That's the highest return on investment of the 448 counties RealtyTrack analyzed. Of course, if you were really investing in a single-family home, you'd have to weigh the cost of maintaining the property, as well as property taxes, and the cost of vacancies or tenants who don't pay, or even the safety of the neighborhood. Let's face it, there's going to be higher expenses in certain markets, says Darren Bloomquist, Senior Vice President of RealtyTrack. Typically, around 40% of gross rent will go to expenses, Bloomquist says. The data released by RealtyTrack is a great tool for would-be investors, renters, home buyers, and job searchers as well. The information not only shows the 17 counties RealtyTrack ranks as the best for investing in single-family homes, but also shows a list of the 15 best counties for investing in single-family homes ranked by the rate of attracting millennials. To see a complete list of information for home buyers and renters, go to realtytrack.com. That's RealtyTrack with no letter K.com, and search for the 2016 Single-Family Rental Market Report. And lastly, the 8 non-negotiable habits of a successful note investor, according to Dave Van Horn. Before we get into the habits, I think it would be good to define what a real estate note is. Real estate notes are a form of real estate investment that is created when a loan provider sells the repayment terms to another party. Usually, the party is an investor. Now that we've done that, let's go to the 8 non-negotiable habits of a successful note investor. Number 1, they don't take no for an answer. Never give up. Here's an example. If a lien gets wiped and is now deemed unsecured, many investors may give up on the deal at this point, whereas a persistent note investor may still explore other exit strategies, such as pursuing the borrower instead of the property, selling to a collections attorney, or selling it on an exchange platform. Number 2, they take real action. Here's another example. Instead of an investor waiting for a borrower to call in, they could already have an outreach program in place, such as a phone, mail, or legal campaign. Number 3, they hold themselves accountable. Learn from your mistakes. One of the biggest mistakes Dave Van Horn made when he first started out was that he didn't do enough due diligence on their note seller, and they never got any of the collateral, in particular, their assignment. Number 4, they stay organized. Be sure to keep good records. This is especially important with things like checking your data, performing due diligence, or measuring outcomes. Number 5, they think outside the box. Creativity is critical when we're working non-performing loans, as well as when running a business. Number 6, they realize they can't do it alone. Network and build relationships with others in the business. You can't be afraid to ask for help. Number 7, they know their numbers. You need to know your numbers if you expect to survive. It also gives others who are dealing with you a level of comfort and confidence. And lastly, number 8, they build rapport. In the note business, you deal with many people, especially borrowers and vendors. If you're unable to build rapport, it will be difficult for them to open up about any challenges they are facing, or for you to work with them on creating a solution. These are just a few habits and characteristics of a good note investor. So, what are some of the other habits or characteristics of a successful investor that you can think of? Let us know. Well, thank you for listening to this week's recap. Please leave your comments below. Have a great day. This has been your weekly real estate investment news recap. Did you find this recap helpful? Please like or comment below this video to enter to win a free copy of our ebook, The Ultimate Real Estate Guide for Residential Real Estate Investments. You can also subscribe to our channel or go to our website to receive the latest in real estate news. Our website also affords you the opportunity to view our latest turnkey properties.